So in our last class, we were solving a question, but time could not allow us to complete the question. So today we are going to complete the question, and at the same time, we had additional illustration to complete the topic. All right. So I want to believe all of you have tried your best during the week to go through the last illustration that we did. So I think we have completed NPV, so we are left with internal rate of return and then the discounted payback period. So if that is the case, without wasting more time, let's calculate internal rate of return and discounted payback period. All right. So let me please open to the question at your end so that we'll be following the scenario together. Let me share the working notes so that quickly we complete the question and move to the next one. Okay. So we are still on the question of Washington PLC. That's the name of the company. So number A2, requirement number A2. We want to calculate internal rate of return. So I would then say calculating internal rate of return. We said that internal rate of return is the rate of return that equates the NPV of future cash flows to zero. Any rate that you assume that produce zero NPV, that is the internal rate of return. And I said that there are 3 steps you are expected to carry out anytime you want to compute internal rate of return. Step 1, you assume 2 discount rates that will produce 2 opposing NPV. One discount rate will produce a positive NPV, then another discount rate will produce a negative NPV. Then step 2, you proceed to calculating the internal rate of return using IRR formula, okay? Then step 3, you advise whether the project should be accepted or not, all right? So those are the 3 steps you are expected to carry out whenever you want to calculate internal rate of return. One thing you need to understand is that when you are calculating internal rate of return, you don't use the company's cost of capital. You are the one that will assume 2 different discount rates to compute your NPV, all right? So a discount rate will produce a positive NPV, and then another discount rate will give you a negative NPV. So you are the one that will assume the discount rates. Don't expect that. Don't go to the question I'll be looking for cost of capital to use for your IRR. And that's why one of the disadvantages of IRR is that it's subjective, all right? Because whatever the discount rate that you think is appropriate is what you are going to use, all right? So that is for that. Then after the calculation, you are supposed to compare your calculated internal rate of return with the company's cost of capital whenever you want to make a decision whether the project should be accepted. That's basically what we have discussed previously as far as internal rate of return is concerned. Therefore, now we want to calculate the internal rate of return. So I would then say assume. Now, in the question we solved last week, the NPV we calculated, I told you that the NPV that I've done previously was positive. So the reason being that the reason why you have that negative one is because of the fact that we rounded the number to odd number. If we have done it like 2 decimal places or 2 decimal points, would have had a positive NPV. So I will expect that on your own, you can just go ahead and recalculate it and see what you are going to get at the end of the day. Of course, certainly it will be positive, all right? So it will be positive because the same question I solved with you, I've also solved with other students elsewhere, and of course, it's still the same, is positive. So, all right, so that's basically that. Now, let me do it this way. Let me do it this way. Okay. Do I need to, please, I want to find out, please, do you have the question that, I mean, the solution that we had last time? Do you have it with you? Is anybody, any one of you, do you have the solution? I mean, for example, the sales value, the variable cost, the workings that we do generally last week, do you still have it with you? Hello? Am I speaking to myself? I just want to be sure if you have it. Kemi, Olukemi.
Yes, we have it, sir. Oh, I have it.
Okay. Okay, if you have it, in that case, let's quickly go through that so that we start. I mean, we're not starting afresh. I just want to pick some numbers there. So let me repeat. Let me change this one to NPV, calculating net present value. So you never can tell. At times, examiner do repeat question, and then so that you don't go and fix in your mind that okay, the NPV was negative when we calculated it in the class. So that uh, let me see if you can quickly within the next few minutes. Okay. So this is year 0, year 1, year 2, 3, 4, 5. Then we have workings. So for year 1, for example, what's the cash flow? What's the sales value for year 1? Yes. Please, when I ask you a question, answer me fast so that we can move as quickly as possible.
We have
Yes.
42.
42. Okay, so what I want to do is to restrict our number to 2 days. If we are not using thousands, so we are using millions. So let's restrict our number to 2 decimal places. So for year 2 cash flow, what did you have?
Cash flow.
Year 2 sales value.
170.
170. You know, it was 169 point something, right?
Yeah.
169 point something something. All right.
Yes, 169.82.
Okay, 169.82. Then year 3. I think that one
23. 231.5.
231.5. Okay. Then year 4.
36.46.
Okay, 36.46. Thank you. I think that's me answer, right?
Yes, sir.
Okay, then. So after sales value, we also calculated working for variable cost. In year 1, what do you have for variable cost?
You have 18.72.
18.72. Okay. Then year 2.
75.71.
75.71. Year 3.
143.42.
143.42. Okay, year 4.
23.87.
23.87. So that's the variable cost, working number 2. Then fixed cost. Incremental fixed cost. Incremental fixed cost. For year 1, it was a 10.5, right?
10.5. Yes.
Okay. Year 2,
11.
11.000.
00.
Is it 0005? You know, okay, this one should be easier for us. So the inflation rate for fixed cost is 5%. Therefore, 10.5 multiplied by 1.05. Sorry, something. 10.5 multiplied by, hey baby, Samuel, you can mute a little bit, you can mute. Multiply by 1 point, I think I can carry on from here. Multiply by 1.05. So that's 11.03. This is 11.03. Then what I have in the calculator, multiply by 1.05. This is 11.58. 11.58. What I have in the calculator multiplied by 1.05. So that's 12.16. Here is 12.16. So that's that. I think I'm good from this point. So we then get the profits. We calculated the profit from here. So for year one, this should be 42 minus 18.72 minus 10.5 equal, that's 12.78. Here is 12.78. Then for year two, profits 169.82, sorry, 169.82 minus 75.71 minus 11.03 equal, that's 83.03. 83.03. Then year three profits will be equal to 231.5 minus 143.42 minus 11.58 equal, that's 76.5. 76.5. Then 36.46 minus 23.87 minus 12.16 equal 0.43. There is 0.43 dash. Then after profit, we determine tax liability. And tax rate according to the question is 30%. And we are told that tax is paid 1 year in arrears, which means that the profit of year one will be taxed in year two. So I would then say 30% of 12.78. 12.78 multiplied by 0.3 equal, that's 3.83. Here is 3.83. Okay. The profit of year two, which is 83.03 multiplied by 0.3. That's 24.91. Here is 24.91. Profit of year three of 76.5 multiplied by 0.3 equal 22.95. 22.95. Then profit of year four, which is 0.43 multiplied by 0.3 equal 0.13. 0.13. So that's the tax liability for each year. Then after this, we adjusted for tax saved on capital allowance. We calculated tax saved on capital allowance in the first year to be 9 million. Okay. In the second year is 6.75. In the third year is 5.06. I think I still remember. I can't remember the fourth year, which is I think is 12.18 or 19. Please, somebody should confirm. What's
I
the
think
task?
12, it's just 12. 12
You know,
million.
we
There's no
rounded it.
confusion.
We
Yeah,
rounded
right.
it.
Yes.
So 40, I think 40 point, the balancing allowance was 40.63 or something. I can't remember. Then we multiply tax rate on it. So we go at 12 point, either 18 or 19. You can confirm from your end. Somebody should help me confirm that, just to be sure.
I think it's 16.
Okay.
12.16.
Okay, 12.16. Then number 4. Then after this, of course, we consider the STRA value. STRA value, according to the question, is 10 million. Okay. Then after this, we have initial outlay, which is 120 million in year 0. Okay. Then after that, we have working capital. Working capital in year 0 was 20, based on our calculation. In year 1, we have 0.60. In year 2, we have 0.62. In year 3, we have 0.63. Then in year 4, I think that was the 12, is it 12?
No, it was
21.
219.
No, in 2 decimal place, that's 21.85. I think. Please confirm. I think we can even do this one by ourselves. So let me just confirm it. The inflation rate is 3%. Therefore, 20 multiplied by 1.03. So that's 20.6. Okay. So 20.6 minus 20, that's what gave us a 0.6 of year 2. Then multiply by 1.03. That's 21.22. So that's what gave us that 0.62. Then again, multiply by 1.03. That's 21.85. That's it. It's correct. 21.85. Okay. So that's that. So this one is cash outflow, cash outflow, cash outflow, then we recover. This is working number 5. Okay. So at this point, we just get the net cash flow. Simon, Mary, Rose. Yes, talk to me. What's your question?
Sorry, how you got that 0.63?
How we got it?
Yes.
If you go back to our workings, let me just, I will clean it. Let me just demonstrate it. Here is 20. This is the way we calculated the 20 for year 1, year 2, year 3, year 4. This is the working capital. Then we have inflation at 3%. Okay? So this is, of course, we now say 1.03 raised to power 0, 1.03 raised to power 1, 1.03 raised to power 2, 1.03 raised to power 3. This is the way we calculated the last week. There will be 20. Okay? Now, 1.03, 1.03 raised to power 1. Okay? Sorry. 1.03 raised to power 1. Then
That's 20.
equal. Multiply by 20.
20.6.
That's 20.6. Here is 20.6. So again, 1.03 raised to power 2 equal, then multiply by 20 equal
21.22.
21.22. 21.22. Then the next one, 1.03 raised to power 3 equal, then multiply by 20. 21.85. Here is 21.85. So this is the inflated working capital. We call this one inflated working capital last week. Then we now did incremental working capital. The first year is 20. From 20, it has increased to 20.6 by 0.6, let's say 0.60. From 20.6 minus 21.22, the difference is 0.62. So 21.22 minus 21.85, the difference is 0.63, I think. Use your calculator, I believe that's 0.63. Then, of course, here is total. Okay, here is total. So we now said, okay, when you add up all of this, 20 plus 0.62 plus 0.6 plus 0.62 plus 0.63, the total will give us 21.85. So we now said that, of course, the working capital should be treated as cash outflow in the year before the year of occurrence and then recover fully at the end of the useful life. Relevant year. We said this one should be treated as cash outflow in year 0, year 1, year 2, year 3, then in year 4, you recover it. So, Rose, can you see now we got the number?
Yes, sir. Yes, sir. Thank you.
Then. You're welcome. So I will just clean this. This is just to demonstrate to Rose. Okay. So let's go back. Somebody should get me the net cash flow for each year. Of course, this one is 140. What about year 1?
11.
11, no, 2 decimal place.
Uh,
That will be 12.18. Isn't it? That's 12.18. You know, we are recalculating. I was telling you earlier today. I also told you last week too. That negative NPV that we got is because we rounded our number to whole number. That's why we got it. It's supposed to be positive. The reason why I have to redo it is because of the fact that, you know, at times examiner do repeat question so that you don't go and fix your mind that, oh, when we calculated this question, we got -1. So I don't want to, so that you are not misled. And that's why I have to redo it in 2 decimal place so that you see what I'm talking about. So in this case, for year 2, net cash flow, what do you have there? Yes. Year 2 net cash flow. Okay.
87.58.
87.58. Year 3.
57.71.
Pardon?
57.71.
57.71.
Yes, sir.
Okay. I think this one is 12.03. Year 4. Year 4. 0.43.
14.39.
14.39.
Yes.
Okay. 14.39. All right then. So we then calculated discount factor. What do you have at discount factor of year 1? Here is 0.901, I think. Then year 2, 0.8 what?
812.
812.
Excuse me, sir.
Year 3, 0.731, right?
31.
Okay. Then year 4, 0.659 or 656?
659.
657.
7, okay. Then year 5,
Excuse
0.
me, sir. Year two is supposed to be 44.84, not 57.71. Or year three, rather,
Year 3 is supposed to be,
44.84.
okay, let me confirm that. 76, sorry, let me clean. 76.5 minus 24.91, okay, plus 6.75, okay, minus 0.63. That's 57.71 is correct. It's 57.71. So
Correct, sir.
what's
It's
this?
deducted this stuff.
Okay, so what's discount factor of year 5? 1.11 raised to power 5 minus equal
0.593.
593. So that's it. We said this one is working number 6 because we calculated this 11% using Fisher effects for money cash flow. So we then
Sir, Mr. Adejumo, sir.
yes, go ahead.
The discount factor for year 4 should be 0.659, not 657.
659, okay.
Yes.
Again, let me confirm that. 1.11 raised to power 4 minus. Yes, thank you. 659.
Yeah.
Okay. Now, PV of year 1 will be 12.18 multiplied by 0.901 equal. That's 10.97. Here is 10.97. Year 2,
Year 2 is 71.11.
71.11. Year 3,
42.19.
okay. Year 4,
I have 9.48.
9.48.
Yes, sir.
Then year 5,
I have 7.13.
7.13. So to now get the NPV, the net present value, we are supposed to add up all the positive present value. So in this case, I would then say 7.13 plus 9.48 plus 42.19 plus 71.11 plus 10.97 equal, then minus 140 equal 0.88. It's supposed to be 0.94 or 0.93, but again, maybe when you do on your own, you can go through it together.
Yeah, I got the same thing, 0.88.
So that's that. So this is the NPV, all right? So in the second part of the question, you are to calculate internal rate of return. So I would then say calculating internal rate of return. And I told you that when you are calculating internal rate of return, you are supposed to assume two discount rates that will produce two opposing NPV. One discount rate will give you a positive NPV, and another discount rate will give you a negative NPV. Now, my target, since I've already calculated NPV before using 11% and we got positive 0.88, my target will be that I will just assume any discount rates above 13%, I should be able to get negative. But to be on a safer side, let's use 15%. And I told you, whenever you are calculating internal rate of return, the difference between the two discount rates that you are going to assume should not be more than 5%, because it is not attainable in the market. You can't just move 100% just like that. You assume 10%, 10% is positive. You just shoot it to 20%. So it doesn't work like that. All right. So you can't just assume 15%, then from 15% you push to 30% because you are looking for negative NPV. So that's not realistic. All right. So I will then use, now I've assumed initially 11%, we got 8.88 positive. So I've increased it to 15% to get a negative NPV. So if I like, I can change my format to the normal one you are used to. So I can just say here, cash flow, okay, discount factor at 15%, then present value, year 0, 1, 2, 3, 4, and then 5. Cash flow of year 0 is 140. Year 1 net cash flow, we got 12.18. Here is 12.18. Net cash flow of year 2, 87.58. 87.58. Net cash flow of year 3, we got 57.71. 57.71. Cash flow of year 4, we got 14.39. And then 12.03. Okay. That's the net cash flow. So we discount this at 15%. 15% for year 1 is 0.870. Then 1.15 raised to power 2 minus year 2 discount factor is 0.756. Year 3, 1.15 raised to power 3 minus 658. 658. Then year 4,
0.572.
year 5,
0.497.
497. So we now get the present value. You multiply the cash flow with the discount factor. Here is 140. Okay.
Year 2 is 10.60.
10.60. Okay. Here is I'm coming 5.98. You said 10.60. All right. Then year 2.
Year 2 is 66.21.
66.21. 66.21. Okay.
Year 3, 37.97.
37.97. Year 4.
8.23.
8.23. 3.
3.
So we then add up. We add up, get the NPV. So here is 5.98 plus 8.23 plus 37.97 plus 66.21 plus 10.6 equal, then minus 140 equal, that's 11.01 negative.
Negative.
Okay. Here is 11.01 negative NPV. So since 15% produce negative NPV of 11.01, then we assume 11% which produce 0.88. We then use this to calculate our internal rate of return. I would then say IRR equal to lower discount rate plus the NPV of the lower discount rate divided by NPV of the lower discount rate plus NPV of the higher discount rate, all multiplied by higher discount rate minus lower discount rate. So IRR will then be equal to, we assume 11% and 15%. 11% is lower plus NPV of the 11%, 0.88 over 0.88 plus NPV of the higher, that's 11.01. Okay, higher discount rate of 15 minus lower discount rate of 11. Therefore, I would then say, starting from the denominator, 0.88 plus 11.01 equal to 11.89. So 0.88 divided by 11.09. Sorry, is it 0? No, it's 9. Sorry, 11.89 rather. 11.89 equal, then multiply by difference between 15 and 11, that's 4, equal, then points, sorry, plus 11.
11.230.
11.30. Okay, that's 11.30, approximately 11. IRR is approximately 11% or 11.30 first. Okay, 11.30, approximately 11%. Okay, so that's that. Then the third one says we should calculate discounted payback period. Calculating discounted payback period. And I said that discounted payback period is calculated the same way as the normal payback period. The only difference is just that the cash flows are discounted to the present value equivalent before calculating payback period, which means that whenever you want to calculate discounted payback period, you are supposed to use present value to recover the initial investment. So in this case, if I want to, of course, to calculate this, I will create a column for year. Now, since we've already calculated present value, so I will instead of me to say cash flow multiplied by discount factor to get the present value, we've already calculated the present value. So I will just pick the present value, then I will use it to recover the initial investment, cumulative. Year 0, 1, 2, 3, 4, and then 5. Present value for year 0 is 140. That's what we want to recover. In year 1, present value of year 1 that we calculated was 10.97. 10.97. Here will be 10.97. In year 2, it was 71.11. 71.11. In year 3, present value,
42.19.
that's 42.19. 42.19. In year 3, it was
48.
9.48. That's year 4. Then year 5, we got 7.13. 7.13. So we want to use this present value to recover the initial investment of 400. Therefore, I will then say 140 from my calculator. 140 minus 10.97 equal, I have a balance of 129.03. Here is 129.03. So 129.03 minus 71.11. We got 57.92. 57.92. So from my calculator, 57.92 minus 42.19 equal 15.73. Okay, so 15.73 minus 9.48 equals 6.25. So when you get to a point where your outstanding balance is less than the next cash inflow, you put a dash and you calculate the discounted payback period. In this case, discounted payback period is equal to, we have recovered 4 years. We have recovered for 4 years. All right, so here will be 4 plus the outstanding balance of 6.25 over the next cash inflow of 7.13. So that will give us discounted payback period. This should be 4.9 something something. Let me see.
4.0897.
Divided by 7.13. Okay, then plus 4. That's 4.88. So 4.88 years. The discounted payback period is 4.88 years. So this is how to calculate discounted payback period. If not because of the fact that we have calculated present value before, of course, it would have been more than this. Just create a column for a year, the cash flow, okay, the discount factor, the present value, then the cumulative. So this will be the format. I think I gave you this format last week. All right. So this is the format you are going to create if you want to calculate discounted payback period. But because we have already calculated present value, that's why we ignore other columns that we have. Okay. So that is as per that. Now let's go back to the question. Number C, so number B, we are told that on the basis of NPV, advise if the project should be considered. Of course, the project produced a positive NPV, then it is financially viable. So I will just come here, number B, advise. So examiner say on the basis of NPV, we should advise. I will then say the project is financially viable, considering the positive NPV of 888 million naira. Therefore, the project should be accepted. All right. Therefore, the project should be undertaken or accepted. So that's that. Then number C, examiner is asking you to state your assumption. Now, this number C, whether you are told or not, is something you must do. Anytime you have calculated NPV or whatever, you have appraised the project, it's expected that you are going to state your assumption, because there are some cash flows given to you in the question whereby you ignore them. Why did you ignore it? So you have to state the reason. Therefore, on this one, I will just say assumption. So the calculation above is based on the following underlying assumption. The following underlying assumption. What are the assumptions? Now, pay attention on this. Anytime you want to state your assumption under capital budgeting, it's a must that you talk about cash flow. Number one, you need to talk about cash flow. What's your assumption on cash flow? Let's state it down. It is assumed that the cash flow estimates are realistic and will occur at the end of each year. At the end of each year. What do I mean by this? All those selling price, the variable cost, the incremental attributable fixed cost, our assumption is that they are going to occur at the end of each year, and that those values will actually be achieved. So that means they are realistic. All right. Then assumption number 2. Again, in a question, if you have calculated, you have evaluated a project, if you are given cost of capital, of course, there is no way you will evaluate without using cost of capital, especially if you are calculating NPV. So you talk about cost of capital. So what's your assumption on cost of capital? So this assume that, or it is assumed that, the cost of capital, we have calculated cost of capital of 11%. So the cost of capital of 11% is appropriate. And consistent. Is appropriate and consistent with the cash flow. And project risk. What do I mean by this? We are given real cash flow, and we have converted the real cash flow to we are given real cost of capital, and we have converted that real cost of capital to money cost of capital, so that it will be consistent with the money cash flow that we have calculated. So our assumption here is that this cost of capital of 11% is appropriate and consistent with the cash flow, money cost of capital for money cash flow. Not only that, the cost of capital is also in consonance with the project risk. It aligns with the project risk. So that's our assumption with that. Then number 3, again, if in the question you have been given inflation rates, then you need to talk about inflation rates. You need to talk about inflation. What assumption have you made on inflation? We are given different inflation rates. So our assumption is that, okay, it is assumed that, It is. Assume that the inflation rate or the specific inflation rates, the inflation rates will remain constant, will remain constant within the period under consideration, within the period under consideration. You know, we have inflation rate for variable cost, inflation rate for fixed cost, inflation rate for selling price. Say, for example, if the inflation rate for variable costs and fixed costs increase beyond what it is, certainly the decision to accept the project will change because your cost will go up. If your costs go up, then your NPV may be negative. So our assumption here is that the inflation rates, the specific inflation rates given to us will remain constant within the period under consideration, or will remain constant within the relevant range. Okay? Then number 4, any other assumption that you have made in the question. For example, in this question, we also have some costs. In the question, you are given development cost of 8 million naira in the first paragraph. You are also given 2.5 million naira for market research costs. We ignore them. We did not put it in our calculation. Why? Because they are sunk costs. Okay? So I would then say the development costs of 8 million naira and market research costs of 2.5 million naira are sunk costs. Therefore, not relevant to the calculation. Okay, that's our assumption. So any other assumption that you have made in the question, you indicate it. That's all. Okay, so we are done with that. Let me know if you have any question for me so that we can move to a brand new question. All right? Any question? So that we can move on to the next one. So I will stop sharing this. Let's have one more illustration, big one. Okay. Let me see. No. Let's have a question that involves project specific. You know, I promise you that when we go to capital budgeting, we are going to solve another question where you have capital budgeting and then project specific together. It's not in this material. Let me see. Let's just in case, let me quickly stop sharing this. Okay, so I need one of you to read this question for us. Who is helping us? Who is helping us to read it? Yes, Rose, go ahead. Thank you. Others should please mute.
Ferrari PLC is a listed company based in Warri, Delta State. Has been involved in producing boats, but excluding engines. The company is now considering diversifying into the production of a major component of outboard engine. For this purpose, the company has recently purchased the patent rights for 15 million naira to produce the component. Ferrari PLC has spent 20 million naira developing prototypes of the component and undertaking market studies. The research studies concluded that the components will have a significant commercial potential for a period of 5 years, after which newer components will come into the market and the sales revenue for the component will virtually fall to zero. The research studies have also found that in the first 2 years, that is the development phase, there will be a considerable training and development cost, and a fewer components will be produced and sold. However, sales revenue is expected to grow rapidly in the following 3 years, the commercial phase. It is estimated that in the first year, the selling price will be 2,000 naira per component. The variable cost will be 800 naira per component, and the total direct fixed cost will be 6 million naira. Thereafter, while the selling price is expected to increase by 8% per year, the variable and fixed costs are expected to increase by 5% per year for the next 4 years. Training and development costs are expected to be 120% of variable costs in the first year, 40% in the second year, and 10% in each of the following 3 years. The estimated average number of outboard engine components produced and sold per year is given below. Year 1, year 2, year 3, 4, and 5. Machine costing 480 million will need to be installed prior to commencement of the component production. Ferrari PLC has enough space in its factory to manufacture the components, and thereafter we incur an additional rental cost. Tax allowable depreciation is available on the machinery at 10% on straight line basis. The machine is expected to be sold for 160 million at the end of year 5. The company has sufficient profits from its other activities to take advantage of any tax reliefs available from this project. Initially, Ferrari PLC will require additional working capital for the project of 20% for the first year, sales revenue. Thereafter, every 1 naira increase in sales revenue will require a 10% increase in working capital. Although this will be a major undertaking for the company, it is confident that it can raise the finance required for the machinery and the first year's working capital. The financing will be through a mixture of a rights issue and a bank loan in the same proportion as the market values of current equity and debt capital. Any annual increase in working capital after this first year will be financed by internally generated funds. Coscharis PLC is a listed company involved in the manufacture of outboard engine components for many years. Additional data extracted from statement of financial position is given as follows. The loan notes of Coscharis PLC are quoted at 102 naira per 100 naira. Other data. Tax rate available to Ferrari and Coscharis PLC is 20%. it can be assumed that tax is payable in the same year as the profit on which it is agreed. Estimated risk-free rate of return is 3%. Historic equity market risk premium is 6%. Required. Given the information of Costaris PLC and the project financing mix, including any other relevant information, calculate the project-specific cost of capital. 5 marks. B. Assess whether Ferrari PLC should undertake the project of developing and commercializing the major components of the outbound engine, assuming a discount rate of 12% has been applicable on the assessment, irrespective of your calculation in A above. 22 marks. In C, state any 3 relevant assumptions made for your calculation in A and B above. 30 marks.
Yes, thank you very much, Rose. You can see this is a big question. This is a big question. If you are going to have a capital budgeting question on that day, this is the kind of question that you are going to be given. All right. This kind of a question usually come as compulsory. All right. It usually come as a compulsory question. So if that is the case, let's solve this. Now, what I will do is that can I even quickly, do I even have it somewhere so that I can share with it on WhatsApp so we follow through together. Let me see if I can. So according to the question in the A requirements, we are told that given the information on Costaris PLC and the project financing mix, including any other relevant information, calculate the project specific cost of capital. So examiner is direct in this question or in this requirement. So you have to calculate project specific cost of capital. So I will then come here, number A, calculating project specific cost of capital. We said that whenever you want to calculate project specific cost of capital, there are 5 procedures you are supposed to carry out. The first procedure is to identify the proxy beta. Step 2, you ungear the beta if it is geared. Step 3, you regear. Step 4, you calculate cost of equity using capping. Then step 5, you calculate project-specific WACC. So in this question, the main company is Ferrari PLC. Another name was mentioned, which is Costaris, which means that Costaris is the proxy company. I will then go back to the question to go and identify the beta of Costaris. When you look at the additional data given to you in the table, you will see quoted beta 1.3 for Ferrari, then 1.8 for Costaris. Whenever you want to calculate project-specific cost of capital, you don't need the beta of the main company for anything. You don't need the beta of the main company because that beta will not be consistent with the risk associated with the project. Therefore, you need the beta of the proxy company. All right. So it is the beta of the proxy company you are going to adjust to calculate a suitable cost of capital for the company to evaluate investments. So in this particular question, you have been given a beta of 1.18 for Costaris PLC. That is the proxy beta. So I will then go back to my calculation. There is no need for you to say identify proxy beta. Just simply put proxy beta equal to 1.8. With this, we have identified the proxy beta in the question. Then step 2 says you should ungear. You will only ungear the beta of 1.8 if that beta is geared. And I said that the beta will be geared if the proxy company has debt in its capital structure. All right. Of course, as you can see from this question, Costaris PLC has loan notes. Costaris PLC has a loan note of 368 million naira, which means that that proxy beta of 1.8 is geared. If it is geared, then you need to ungear it. So I would then say ungear. How do you ungear? I gave you two different formulas that you can use depending on whether or not debt beta is given. In this question, you are not given debt beta. So that means debt beta is assumed to be risk-free. So if debt beta is risk-free, I would then say beta assets is calculated as beta equity of a gear multiplied by equity value divided by equity value plus debt value multiplied by 1 minus tax rates. Okay, so this is the formula to calculate beta asset or to calculate ungeared beta, where debt beta is assumed to be risk-free. Okay, so if that is the case, I would then say beta assets equal to 1.18 multiplied by, I need to go and calculate equity value and debt value of Costaris, which is the proxy company. Okay, let me see. Regear, cost of equity, WACC. Let me do my working in bits so that I don't switch pages for too long. So let me do the workings for cost of capital here. So I want to calculate market value. Market value. Okay, so I need market value of equity value denoted as E. You know that equity value, depending on the information given in the question. In this question, we don't have number of shares. Therefore, equity value will be share capital divided by nominal value or nominal price multiplied by share price. Again, there's nothing like XD share price when you are calculating project specific, because we don't have anything to do with dividend. So whether dividend has been paid or not, we are less concerned with that. Okay, so for Costaris, for example, equity value of Costaris will be calculated. I will then go to the question, what is the share capital of Costaris? According to the question, share capital of Costaris is 500 million naira at 1 naira per share. So 500 million naira divided by 1 naira. That will give me the number of shares. Then multiply by the share price of Costaris. According to the question in the table, is 3 naira. So when you multiply, this will give us 1,500. Figures are in million. Then the debt value of Costaris debts. According to the question, Costaris has bank loan. So since it's a bank loan for Costaris, you cannot get market value of bank loan because bank loan is not tradable. It's not a traded debt. Therefore, which is a 624. Is it 624? Let me confirm.
It's Ferrari that has the bank loan.
Oh, okay. Thank you very much. Thank you. So that bank loan is for Ferrari. Yes. So 5% loan note, 368 million for Costaris. That's the proxy company. So in this case, debt is equal to market value of the debt is calculated as nominal value multiplied by the market price of the debt of the loan note multiplied by market price. You know, in our traditional work, we call this X inch price. Okay, we call it X inch price. All right, so divided by 100 naira. So the debt value, nominal value is 368 million multiplied by the market price of this loan note, we are told is 102 naira per 100 naira divided by 100. Okay. Therefore, this will give us 368. Let me see. 368 multiplied by 1.02 equal to 375.36, rounding 375. Here is 375 million. Okay, so I can then go ahead with my calculation. I've calculated market value of equity and debt for Postaris. So equity value is 1,500 over 1,500 plus debt value of 375. Tax rate, we are told is 20%. That means we are supposed to account for 80%, 0.80. That's it. I will get my answer. So here will be 0.8 multiplied by 375 equal, that's 300 plus 15, 1,800. Therefore, 1,500 divided by 1,800 equal. Then whatever you have in your calculator multiplied by the beta of 1.18 equal. That's a 0.98. Yes, Kemi, talk to me.
Sir, if while calculating the market value of the debt for Postaris, what
Yes.
if the interest price given is come in? Are we concerned with that?
I said that one will not work. Because here we are less concerned when we don't use interest, whether interest has been paid or dividend has been paid. We are less concerned with that. All right.
Okay, sir.
So that one does not arise under project specific. You can only see that under the traditional work. All right.
Thank you, sir.
You're welcome. So we got my answer. What did I get again? 0.98. Okay. Here is 0.98. Let me do that again so that I don't. Yeah. So that's it. Let me confirm just to be sure. Just to be sure. 375. 375 multiplied by 0.8. That's 300. So 15 divided by 18. Then multiply by 1.18, 1.18. That's 0.98, so we are correct. Then step 3. Step 3 is to regear. Yes, Rose, talk to me.
So how did you
Rose,
get this 0.80? How did you get it?
tax rate is 20%. 1 minus tax will give you 0.8. Is it
Okay.
clear? Yeah. So to regear, since debt beta is assumed to be risk-free, I would then say beta equity of a gear. Beta equity of a gear equal to beta assets multiplied by 1 plus 1 minus tax. Debt multiplied by debt equity proportion of Ferrari in this case. Ferrari is the main company. All right, so this is the formula you are going to use to regear if debt beta is assumed to be risk-free, like in this question. So beta equity of a gear will then be equal to 0.98 multiplied by 1 plus tax rate is 20%, so we are accounting for 80%. Then I need to go and calculate debt equity proportion of Ferrari. Okay, just the same way you calculated for Costaris. So for Ferrari, equity value would then be equal to, is the same formula for Ferrari. Share capital of Ferrari, according to the question, is 208 million per 50 kobo, 50 kobo per share, 208 million. So here will be 208 divided by 50 kobo, 0.50. Then multiply by the share price is 3 naira, 3.5. So what do we have here? 416, 416 multiplied by 3.5. That's 1456. Here is 1456. Then the debt value for Costaris is bank loan. You cannot calculate market value for bank loan because it's not tradable. And the bank loan for Ferrari is 624 million. So you add the two together. That will give us 2080. This is total value. Okay. So in this case, I will then come back here. Debt value of Ferrari is 624 divided by equity value 1456. So I will get the final answer, which is going to be 624 divided by 1456 equal. Then whatever you have in your calculator, multiply by 0.8 equal plus 1 equal multiply by 0.98. That's 1.32. 1.32. Okay. Here is 1.32. Let's confirm that number again. All right. This let me confirm this. Share capital, yeah, 500, yeah, correct. Okay. 500, don't know, 360 is the debt, 368. Yes, no, it's 368. I just want to be sure that I have the right number. So that's it. That's it. Let me confirm again. Oh, sorry. There is an error here. The beta is supposed to be 1.8, but I use 1.18. Is it 1.8? Let me confirm from the question. Oh, sorry. It's 1.8. And so none of you can even call my attention. This one's supposed to be 1.8, not 1.18. So that means you guys are not even paying attention. Femi, Rose. Are you sure you are in this class? 1,500 divided by 1,800 equal, then multiply by 1.8 equal to 1.5. So this one's supposed to be 1.5. Okay, so here will be 1.5. So you have to be very careful. This is an example for you. You can see, my intention was to pick 1.8, but I end up picking 1.18, you know? So you can imagine if I'm in an exam hall and I did that, I wouldn't know, I would have gone far. But something was telling me that it's like this, something is not wrong with this answer. What's happening? That's why I was trying to check out something, you know? So you have to be very careful. So that's lessons learned for you. 624 divided by 1456 equal, then multiply by 0.8 equal plus 1 equal multiply by 1.5 equal to 2.01. Here is 2.01. Okay, that's the gear beta. Then step 4 says you should calculate cost of equity using capping. All right. So cost of equity equal to risk-free rate of return plus beta into market return minus risk-free rate of return. So cost of equity, according to the question, what's the risk-free rate of return?
3%.
3% is the risk-free rate of return. So if that is the case, I would then say 3 plus beta of 2.01. What's market return? In the question, we are not given market return. We are given market risk premium. We are given market risk premium to be 6%. So the difference between market return and the risk-free rate of return is risk premium, which is, in this case, is 6%. Therefore, cost of equity is equal to 2.01 multiplied by 6 equal, then plus 3 equal 15.06. Here is 15.06%. That's the cost of equity. Finally, step 5. I will calculate WACC. That's project specific WACC. Okay. So WACC equal to equity value over equity plus debt multiplied by cost of equity plus debt value over equity plus debt multiplied by cost of debt 1 minus tax. All of that multiplied by 100%. So we have calculated equity value of Ferrari to be 1456. Okay, let me go and check again. Yes, for Ferrari, 1456. Then debt value is 624. So divided by total value is 2080. Multiplied by cost of equity of 15.06%. Okay, for the left. Then for the right, the debt value is 624 million over total value. Total value is 2080 multiplied by cost of debts. According to the question, what's the cost of this loan note? Sorry, cost of the bank loan. The bank loan is 6%, right? The interest rate on the bank loan is 6%. So multiply by 6%, then multiply by 1 minus tax. We are supposed to account for 80%. All right, so that's that. Then from the left, this will be equal to 1456 divided by 2080 multiplied by 15.06. So 10.54. 10.54 plus the other side, which is 624 multiplied by 6 multiplied by 0.8 equal divided by 2080 equal 1.44. 1.44%. So when you add the two together, that will give you 11.98%. So approximately our work is equal to 12%. That's how to calculate project-specific work. That's how to calculate project-specific work. So yes, Kemi, talk to me quickly.
Sir, the asset beta, I know has been going up off and on. The asset beta, is it 1.8 or 1.15?
Asset beta. Asset beta in step 2 is 1.5.
Okay.
We calculated 1.5, yeah. All right. So finally, let's go to the B part of the question. The B part of the question is asking you to calculate, let me see. You are to assess whether Ferrari PLC should undertake the project of developing and commercializing the major component of the outboard engine, assuming a discount rate of 12% has been applicable for the assessment, irrespective of your calculation in A above. So, examiner is asking you to assess. Whenever you are asked to assess, evaluate, advise whether the project should be accepted, the technique examiner is expecting you to use is NPV. All right. Whenever you are asked to assess, evaluate, or determine financial viability, you are supposed to calculate net present value. If examiner wants you to use other technique, you are going to be told directly that maybe, for example, calculate using payback period, IRR, accounting rate of whatever the technique. But where examiner is silent, that means you are expected to calculate net present value, because NPV is a technique that is consistent with the shareholders' wealth maximization objective. So number B part of this question, that's where you have major work. You want to calculate NPV. What are you supposed to do? Very simple. The same way we have calculated NPV under Washington PLC is the same thing we are going to do here. Now, what are you supposed to do? First thing first, let me extend my, okay, before that, let me continue first. So this is number B part. I will then say calculating net present value. Please, on the day of your exam, don't go and be writing NPV just the way I'm doing. You are supposed to write it out full in the first instance. Net present value in bracket NPV, so that going forward you are going to be referencing NPV. All right, so that's that. Our figures are in million. Okay, the figures given to in the question are already in million, so I don't need to be sweating over this. Now I want to outline my table. I want to calculate NPV, then I need to outline my table. So I need to go back to the question, what is the useful life of this project? What is the useful life of the project? The useful life is 5 years, all right? So before I put down my pen to paper to calculate NPV, I also need to check from the question, how am I going to pay my tax? All right, is tax paid in the current year or 1 year in arrears? All right, so according to the question, uh, you are told that it can be assumed that tax is payable in the same year as the profit on which it is charged. So that means tax is paid in the current year. So I don't need, so if that is the case, I will then come here, year 0, year 1, year 2, year 3, year 4, year 5, then I will have colon for workings. Okay, that's what you need to do. Now, again, I want to calculate NPV. I will go back to the question. Am I given selling price? Yes, examiner has given us selling price. Since we have selling price, then we need to go and calculate sales value. We need to estimate sales value. So there is no need, once you have read the scenario, once you have read the scenario from A to Z, there is no need for you to be reading over and over again. Just follow the format that I've provided for you. The first item here is sales value. Therefore, I need to go back to the question and calculate sales value. This page will be for my NPV. So working will start from here immediately. So working after this, we need to state my assumption. Let me go to number C. What's number C of the question, of the requirement, rather? Number C requirement, you have to state any relevant assumption. So let's say page 1 and page 2 will be for my main solution. Then the third page will be for my working. All right. So let's do working for NPV. Yeah. So the first thing I will do is to state the number of years. We have year 1 to 5, 2, 3, 4, and then 5. Then number of units. Please call the number of units for me. Year 1. How many units do you have in year 1?
15,000.
15,000 for year 1. Here is 15,000. Year 2.
40,000.
Year 3.
100,000.
Year 4.
120,000.
And then year 5.
190,000.
Okay, so these are the number of units. So let's say this is A. Then working number 1. I want to calculate sales. So to get my sales, I will go to the question and pick selling price. Pay attention, please. So I'm not going to do this one like the one we did last time. So this is, I want to show you the exam method that you are supposed to apply. I will go to the question and read about my selling price. According to the question, you are told in the top paragraph, you are told that it is estimated that in the first year, selling price will be 2,000 naira per component. So inflation rate for selling price, we are told selling price is expected to increase by 8% per year. So pay attention, please. The selling price given to you is in first year price, and inflation rate is 8%. You recall when I was explaining the concept, if cash flows are stated in first year price or year 1 prices, inflation should start from year 2. All right. So this selling price of 2,000 naira is in first year price. So the first year selling price is 2,000. So you don't inflate the year 1 price. Therefore, like I said, this is the exam method you are supposed to use on that day. So I would then say 1.08 multiplied by 2,000. That is 2160. Here is 2160 for year 2. Whatever you have in your calculator, multiply by 1.08 equal 2333. Here is 2333. What you have in your calculator, multiply by 1.08 equal 2519. 2519. Again, what you still have in your calculator, multiply by 1.08 equal 2721. Here is 2721. With this, I've inflated the selling price. If I want to use primary school, let me just demonstrate that for you. I will clean it up. What I will just say 2000. I can't be doing this. 2000, 2000, hey, 2000. You are still doing this. Your mate has moved to the next one. 2000. All right. This is the selling price. Then inflation. Inflation at 8%. Okay. 1.08 raised to power 0. 1.08 raised to power 1. 1.08 raised to power 2, raised to power 3, raised to power 4. I can't be doing this. This one will waste your time. This will still remain as 2000. This will be 2160. This will be 2333. This will be 2519. This will be 2721. All right. So you don't need this. Well, if this one is more convenient for you, so be it. Please use it so that you don't go and make mistake. But this is better and it's faster. Okay. Now that is that. So after you have inflated you can see that the cash flow, this selling price of year one remained the same. I did not inflate it. Inflation started from year two. This is what I was explaining to you, that when cash flows are stated in first year prices or year one prices, inflation should start from year two. The fact that inflation starts from year two does not mean that your n will be equal to 2. Your n will still remain as 1 in that year 2. Okay, so that is as per that. Then units, I will then say total sale. Let's say this is B, then sales in million equal to A times B. Okay, number of units according to the question is 15,000. So I will then say 15,000 multiplied by 2,000 equal, that's 30 million. So I will put 30. Figures are in million. Then 40,000 units multiplied by selling price of 2160 equal 86.4. 86.40. Then year 3, this will be 100,000 multiplied by 2333. That's 233.30. 233.30. Then year 4, 120,000 multiplied by 2519. That's 302.28. 302.28. Then year 5, 190,000. Okay, multiply by 2721 equal 516.99. 516.99. So with this, we have calculated our sales. So let's go and post. Please call the number for me. The first one is 30, then 86.4. 30, 86.4. So here is 30, 86.40. What about the third year? Okay. 233.3. 233.3. Then I think that one 302.28. Then year 5, 516.99. That's working number 1. I'm done with sales. I will then go to and calculate variable cost. Let's go back to the question. How much is variable cost? Still on the same paragraph. The variable cost will be 800 naira per component. So what's inflation rate on variable cost? We are told that the variable and fixed costs are expected to increase by 5% per year for the next 4 years. Okay? So variable cost is 800 naira per component and inflation rate is 5%. Okay? So I will now go and calculate variable cost. So this is not part of our working. I just use this one to demonstrate. All right. So working number 2, variable cost. So variable costs at inflation rate of 5%. Variable cost for the first year is 800. So to get the variable cost for the second year, I would then say 1.05 multiplied by 800 equal for 840 for year 2. 840 multiplied by 1.05 equal 882. What you have in your calculator, multiply by 1.05, 926. Year 5, what you have in your calculator, multiply by 1.05, equal 972. 972. So I will then multiply this with number of units. Let's say this is B. Is it B or C? C. Therefore, total variable cost in million would then be equal to A multiplied by C. So the first year unit is 15. So here will be 15,000 multiplied by 800 naira. That's 12 million naira. So here will be 12. Then 840 multiplied by 40,000 equal 33.6. 33.60. Next one, 882 multiplied by 100,000 equal 88.2. Year 4, 120,000 units multiplied by 926. That's 111.12. Then finally, year 5, 190,000 units multiplied by 972. That's 184.68. 184.68. So that's that. Let's go and post it. 12, 33.6. Here is 12, 33.60. 88.2. Then year 4. Year 4 is 111.12. So 111.12. Then year 5, which is 517 something. No? Let me confirm again. I think 184.68. 184.68. So working 2. I will then go back to the question. Any other relevant cash flow? Let's go and identify it. Again, we are told, according to the question, we are given fixed costs. We are given a fixed cost of 6 million naira. And I told you that there are 3 different ways examiner can test you on fixed cost. If you are given a fixed cost, no further information. If there's no additional information, it means that fixed cost is not relevant. All right. But if you are given a fixed cost, including depreciation, again, that fixed cost is not relevant, but examiner wants you to do something. What are you supposed to do? You calculate annual depreciation, you less from the fixed cost. Whatever you have thereafter is relevant fixed cost. The third one is if you are given fixed cost, excluding depreciation, and I said that fixed cost is relevant, you need to account for it. But that's not the case in this question because examiner told you that total direct fixed cost, incremental fixed cost, attributable fixed cost, specific fixed cost are all relevant fixed costs. They are all relevant cash flow. So this 6 million naira is a direct fixed cost. It is relevant. Okay. So the inflation rate on this fixed cost, we are told is 5%. Okay. It's 5%. So I don't need to go and do working for my direct fixed cost. I will come here, direct fixed cost at inflation rate of 5%. So the first year price given to us is 6 million. Here will be 6. Our figures are in million. All right. So I will then carry my calculator. Inflation rate multiplied by 6 million. So that will give me 6.3. Here is 6.3 for year 2. Okay. Let me write that to make it clearer. Then what you have in your calculator multiply by 1.05 equal 6.62. 6.62. Again, what you have in your calculator multiply by 1.05 equal 6.95. Year 5, what you have in your calculator multiply by 1.05. That's 7.29. 7.29. With this, I've inflated the direct fixed cost. Let's go back to the question. If you have other relevant cash flow that we need to consider. So according to the question, you are also given, training and development costs. What's wrong with you? Training and development costs. Yes, still on that same paragraph where you have selling price, variable cost, fixed cost. So you're also told that training and development costs are expected to be 120% of variable cost in the first year, 40% in the second year, and 10% in each of the following 3 years. So we are given training and development cost. Of course, it is relevant, so we need to go and calculate working for that. Working number 3. Training and development costs. Training and development costs. So T and D, training and development percentage on variable cost. Percentage on variable cost. So we are told that in the first year is 120%. In the second year, 40% of variable cost, and then 10% going forward. Okay, these are the percentage of training and development cost on variable cost. So if that is the case, I need to determine the training and development cost. So what is 120% of 12 million? Okay, so I would then say 1.2 multiplied by 12. Variable cost in the first year is 12 million. So that's 14.4. Here will be 14.4. All right, our figures are in million. Variable cost in the second year is 33.6. So 33.6 multiplied by 0.4. That's 13.44. Here is 13.44. Variable cost in the third year is 88.2. 10% of 88.2 is 8.82. All right. Then for the fourth year, 111.12. 10% of that will be 11.12. I believe that's correct. Let me confirm. Let me use calculator. 111.12 multiplied by 0.1, 10%. That's 11.11, okay? 11.11. Then here will be 18.47. Let me use calculator. 184.68 multiplied by 10%. That's 18.47. Here is 18.47. So that's that. That's the training and development. So I will then go and post 14.4, 13.44. Training and development. 14.4, it's a cash outflow. 13.44. Then in the third year is 8.88. Sorry, 8.82. Here is 8.82. Then in the fourth year, 11.11. Then the fifth year is 18.47. I believe I'm correct. This is working number 3. All right. So let's go back to the question in case we have other relevant cash flow. So on that same paragraph, there's no other cash flow again. But when you look at the second paragraph of when you look at the first paragraph in the question, you are told that the company has recently purchased the patent rights for 15 million naira to produce the components. That patent right of 15 million naira is a sunk cost. Okay, it's a sunk cost because that cost has already been incurred, therefore not relevant. Also, in the second paragraph, you are told that Ferrari PLC has spent 20 million naira developing prototype of the components and undertaking market research. That 20 million naira is also a sunk cost because it's a past cost. So we ignore it. So no other cash flow again in the question are relevant apart from the initial outlay and then working capital. Okay. So if that is the case, let's determine the profits. Let's determine the profit for each year. So for year one, 30 minus 18 minus 14.4. That's minus 2.4. Here is 2.4 minus. All right. Then in year two, 86.4 minus 33.6 minus 6.3 minus 13.44 equal 33.06. In year 3, 233.3 minus 88.2 minus 6.62 minus 8.82 equal 129.66. In the 4th year, 302.28 minus 111.12 minus 6.95 minus 11.11 173.1. Okay, next one, year 5. We have 516.99 minus 184.68 minus 7.29 and then minus 18.47 equal 306.55. 306.55. So this is the profit. The next thing we need to do is to determine tax. We need to calculate tax. Tax rate according to the question is 20%. And we are told that tax is paid in the year profit is earned. So when you look at the year 1, in year 1 we have a loss of 2.4. In year 1 we have a loss of 2.4. But examiner, of course, you don't pay tax on loss. Whenever a company make loss, you don't pay tax on loss. Okay? However, ordinarily, what we are supposed to do is to ignore the 1st year and then move to the 2nd year because you don't pay tax on loss. However, when you go back to the question, after the 1st table, after where you have number of units, where you have the cost of the machinery of 480 million, the last paragraph of that particular, the last statement in that paragraph states that the company makes sufficient profits from its other activities to take advantage of any tax loss relief available from this project. What examiner is telling you here is that there's a profit. So the company has other business activities where the company makes sufficient profits from which to relieve this loss of year 1. So you have incurred loss of 2.4 million in the 1st year. So you need to, examiner is telling you that you can take advantage of that. So you want to relieve this. Therefore, what are you supposed to do? I would then say 20% of 2.4. 20% of 2.4, 2.4 multiplied by 20, multiplied by 0.2 equal to 0.48. So here will be 0.48. This 0.48 is not in brackets. You are relieving it. You want to relieve your loss. You have made loss of 2.4 in the 1st year. If not because of that information that examiner told you that the company makes sufficient profit from other business activity from which to take advantage of any loss relief. So this loss of 2.4, you multiply company tax rate on it so that you relieve it. That will reduce your loss. So that's how we are going to treat. I'm coming for you, Saida, just hold on. Then I will move to the 2nd year, 33.06 multiplied by 0.2 equal 6.61. Here is 6.61. That's the tax we are paying. In the 1st year, you are not paying tax. You are just relieving your loss. Okay? In the 3rd year, 129.99 0.66 multiplied by 0.2 equal 25.93. 25.93. I'll move to the fourth year. In the fourth year, 173.1 multiplied by 0.2 equal 34.62. 34.62. Then in the fifth year, 306.55 multiplied by 0.2. That's 61.31. 61.31. Okay, so that's that. Yes, Saida, talk to me. What's your question? Saida?
Don't worry, sir.
Okay,
Thank you.
no problem. Yes, so after tax liability, the next thing will be tax saved on capital allowance. We need to calculate capital allowance to reduce our tax liability. So let's go and do working for capital allowance. Working number 4. Tax saved on capital allowance. Okay. So of course we have a format. We have a format. I can say, of course, I create a column for year, narration, costs, then tax saved. Tax saved at 20%. Company tax rate is 20%. So in year zero, the cost of this machinery we are told is 480 million. All right. And according to the question, we are told that tax is paid on a straight line depreciation. All right. Let me see. Yes, tax allowable depreciation is available on the machinery at 10% on a straight line basis. Okay, on a straight line basis. So I can come here, year 1, I want to calculate annual allowance at 10%. 10% of 480 will give us 48. So 48 minus 480, that will give us 432, I think. This is tax written down value at the end of year 1. Then in year 2, annual allowance is the same thing as 48 because examiner has told us it's on a straight line basis. So it's the same thing as 48. Let me use calculator so that I don't make mistake. 480, for example, minus 48. That's 432 minus 48. 384. Here is 384. This is tax written down value at the end of year 2. Move to year 3. Annual allowance is 48. It's a straight line depreciation. All right. So 384 minus 48 equal to 336. Here is 336. Tax written down value. Then in year 4, annual allowance is 48 minus 336 minus 48 equal, that's 288. Here is 288. This is tax written down value at the end of year 4. Remember, the useful life of this machinery is 5 years. So in the final year, you need to compare the tax written down value in year 4 with the sales proceed. So we have scrap value of 160 million. Okay, scrap value of 160 million. The difference is 128 million. This 128 million is called balancing allowance. Of course, this will be in year 5. Year 5 is balancing allowance because the tax written down value from the preceding year is higher than the sales proceed. So when this happens, the difference is called balancing allowance. So now that I've calculated my capital allowance, I need to get tax saved on capital allowance. How do I get my tax saved on capital allowance? You are supposed to multiply the company tax rates on the capital allowance computed for each year. So for year 1, for example, capital allowance is 48, multiplied by company tax rate is 20%. So that's 9.6. So here is 9.6, 9.6, 9.6, 9.6. Then the final year, which is 128. So here is 128 multiplied by 0.2. That's 25.6. So here is 25.6. If I like, I can add up everything. I will add up everything to confirm if I have not claimed beyond the capital allowance I'm supposed to claim. All right. So 9.6 times 4. 9.6 times 4 equal 10 plus, what am I saying? 9.6 times 4 equal then plus 25.6. That's 64. 64 million is the total tax saved. Total tax saved. So the total tax saved should not be more than the total capital allowance claimable. So the capital allowance claimable, capital allowance is equal to the cost of the assets minus scrap value or multiplied by company tax rates. So in this case, capital allowance will be equal to 480 minus 160 multiplied by 20%. So I should have the same thing as 64. Let me confirm, please. So 480 minus 160 equal multiplied by 0.2, that's 64, correct. So that means we have not claimed about beyond what we are supposed to claim. All right, the essence of this one is to just confirm that you have not claimed more than what you are supposed to claim. Yes, Kemi, talk to me.
Yes, sir. In our last class, you
Yes,
said there are two ways to claim capital allowance. Can you please quickly use the second method with the capital allowance with this
I
little
said you can use
illustration?
capital allowance to reduce your tax liability, or you use tax saved on capital allowance to reduce anyone you use, you get the same answer. All right? But
Okay,
right
sir.
now,
Okay.
I can't use that because of time. We have about 13 minutes more, and we still have a lot to do. All right? But
Okay,
that
sir.
notwithstanding,
Quickly, if we are not told that data relief advantages is given for having loss in that first year, I don't think the company will pay any tax
pardon?
liability. Where they are making loss in the first year, if you are not told
Yes.
in the question, will be a relief.
So you
I
just
don't
put
think
a
they will pay
dash.
anything.
You
Okay.
put a dash because you can't pay tax on loss. So you just put a dash on that. Why is this thing? Is it because of the copy that I did? This is this. Oh, okay. This one has moved. This one has moved. The workings. This has moved to this side. Let me copy it and push it up there. That's not a problem. So, as we proceed, I mean, like, of course, that we maybe in another areas, I will show you where you can use capital allowance to reduce your tax liability instead of tax saved. Of course, you are expected to get the same answer though. All right, but for now, because we have limited time, but let me see if after this class, we still have free period. I can quickly use that one to do it, to demonstrate for you. Okay, Kemi. All right, so this one should come down here. Stay here first. So let this one come down. Is it? Let's see. Okay, yeah. Okay. Because I create additional pages, that's why that thing shifted. So I think it's fine now. Okay. So we have calculated tax saved on capital allowance in the first year to be 9.6. Okay. That's 9.6. Why are you hanging? Don't waste my time. We're almost done. What's the issue again? Okay. Now, this 9.6 below there now. My pen is not connecting. Let me try this other one. Still working here. Come on now. Don't waste my time. I'm battling with my pen. It's not connecting. Okay. No worry. Let me see. I don't know what your problem is. So no worry, we'll soon be done. Mary, hold on. Don't sleep yet. Just hold on. Don't leave me behind. Okay. Tax saved we calculated for the first year is 9.6, 9.6, 9.6, 9.6, then 25.6. This is working number 4. Then after tax saved, we have scrap value. According to the question, scrap value is 160 million. Okay. Then we have initial outlay. We're almost there, Mary. Initial outlay. The cost of this machinery is 480 million. That would be in year 0. All right. Then we have working capital in the question as well. Working capital. So let's go back to the question and identify the working capital. So according to the question, you are told that, yes, initially, Ferrari PLC will require additional working capital for the project of 20% of the first year's sales revenue. Thereafter, every ₦1 increase in sales revenue will require a 10% increase in working capital. All right. So we are told that working capital is a 20% on the first year sales, but thereafter we should consider any increase in sales value. We should take 10% of working capital. So if that is the case, what are you supposed to do? Let's go and do working quickly for working capital. That will be working number 5. Let me start here. Working number 5, working capital. Working capital. for year 1, year 2, year 3, year 4, year 5, then total. Okay. Now, we are told that, first thing first, we are told that working capital is 20% on the first year sales. And for every ₦1 increase in sales value, in sales revenue, we should account for 10% of working capital. So what are you supposed to do? First thing first, you must determine the incremental sales. All right, you must determine the incremental sales. So in this case, I would then say incremental sales first. The sales of year 1, we calculated sales of year 1 to be 30 million. Sales of year 1 is 30 million. Sales of year 2. Sales of year 2 is 86.40. You can see that from 30 million, it has increased to 86.40, difference of 56.40. So incremental sales in the second year is 56.40. In year 3, sales has increased from 86.40 to 233.30. So let's determine the difference. 233.3 minus 86.4. That's 146.9. Okay, year 3 incremental sales is 143.9. Then in year 4, 146. So in year 4, sales has increased to 302.28. So I would then say 302.28 minus 233.3. So sales has increased by 68.98. Okay, 68.98. In year 5, sales has increased to 516.99. So I would then say 516.99 minus 302.28 equal 214.71. 214.71. Here is 214.71. So these are incremental sales, but this is not what you are looking for. To get my working capital, examiner now told us that working capital percentage on sales, on incremental sales, we are told that the first year sales, we should account for 20% working capital. Then for every ₦1 increase in sales revenue, we should account for 10%. So sales revenue has increased by 56.4, 146.9, 68.98, and then 214.71. So we are supposed to account for 10% increments. Therefore, I would then say working capital. My working capital will then be equal to 20% of 30. That will give us 6. Okay? 10% of 56.4. That will give us 5.64. 5.64. Let me confirm that. I think that should be it. 56.4 multiplied by 0.1. That's 5.64. Okay. Then this one will be 14.69. This one will be 6.70, sorry, 6.90. Let me confirm. 68.98. multiplied by 10%. That's 6.898. So that's 6.90. Then the 50 year, 214.71 multiplied by 0.1. That should be 21.47. Here is 21.47. All right. So all I need to do is to add up all the working capital together. All right. These are the working capitals. There's no need for you to do any increment again in your working capital. You've already done incremental sales. You can't do increment twice. So you have done incremental sales by arriving at all these numbers. So there's no need for you to come here again and be doing incremental working capital. So this is how you are going to calculate your working capital. Finally now, all I need to do is to just determine the relevant year. I would then say relevant year. My total working capital would then be equal to, I will add everything together. So I have 6 plus 5.64, sorry, 5.64 plus 14.69 plus 6.9 plus 21.47 equal 54.7. Total working capital is 54.7. The rule says that working capital should be treated as cash outflow in the year before the year of occurrence and then recover fully at the end of the useful life. So cash outflow in year 3, cash outflow in year 4, then at the end of the useful life, which is year 5, I will recover the entire working capital. So this is how we are going to treat the working capital. Let me write it out in full since I have space. Okay, so the first year is 6, then 5.64. So in year 0, this is 6, 5.64. What's the next one? What's the next one? All of you are just muted. 14.69. 14.69. Okay, here is 14.69. The next one is
6.90.
what do you say is that 6.90.
6.90.
6.90, then 21.47. 6.90. So here is 6.90, 14.97. Then in year 5, we recover everything, which is 54.7. This is working number 5. Then at this point, I determine my net cash flow. Please, this year 4 working capital, is it 14.97? Let me confirm.
21.47. 21.47.
Oh, okay. You can see. And I wrote 14.97. 21.47. Okay, then. So this is the net cash flow. So let's get the net cash flow for each year. I will do for year 1, which is 0.48 plus 9.6 minus 2.4 minus 5.64 equal, that's 2.04. Here is 2.04 positive. All right. Then the second year, that will be 33.06 minus 6.61 plus 9.6 minus 14.69 equal, that's 21.36 positive. Then year 3, we have 129.66 minus 25.93, okay, plus 9.6 minus 6.9, 106.46, 106.46. The fourth year, 173.1 minus 34.62 plus 9.6 minus 21.47 equal 126.61. Year 5, 306.55 minus 61.31 plus 25.6 plus 160 plus 54.7 equal 485.54. Okay, so I will then determine the discount factor. According to the question, the examiner said we should use 12%. You can see, you are just told to use 12%. Examiner did not call that 12% money cost of capital or real cost of capital. So it is assumed to be money cost of capital. All right. The 12% given to you in the question is assumed to be money cost of capital because examiner is silent. All right. So I will then calculate discount factor for year 1 at 12%. So this will be equal to 1.12 raised to power minus 1. That's 0.893. 0.893. Discount factor for year 2, what do you have? Moses, I'm very sure you are no more in this class because I can't hear your voice since.
0.797.
0.97, 0.797. Thank you. Number next.
718.
718. Thank you. Then 6.
6.
6 what?
636.
Okay. Year 5.
0.567.
567. Thank you very much. You're my partner. All right. You're my partner. So the next one is present value. So here will be 486 negative. So let's calculate present value for each year. 2.04 multiplied by 0.893. What do you have there? Yes.
1.823.
1.882. You know, we are doing 2 decimal points. Okay. Then year 2.
17.02.
17.02. Year 3, 106.46. Multiplied by 0.718.
76.43.
76.43. Okay.
80.52.
80.52 for year 4. Then year 5.
Is that 48554?
Yes, 485.54 multiplied by 0.564, 0.567.
275.30.
275.30. So at this point, we then calculate our NPV. We add up the positive present value with minus 486. Final answer. Okay.
486. Negative 34.91.
Negative, it has to be positive. Maybe you started from 486. So you need to start from the positive first. So you start from the positive, which is 1.82. Let me consider that. 1.82 plus 17.02 plus 76.43. Okay, then plus 80.52 plus 275.3 minus 486, 34.91. The difference is 34.91. Let me see. That's negative. That means it's not viable. It's negative. Okay, that's it. That means you are correct. Kemi, I think that's Kemi, right?
Yes, sir.
Yes, okay, you are correct. So that's it. That's it. It's not viable. 35 million naira approximately. That's not viable. Now let's go back. We're almost there. So again, of course, in number C parts, examiner is asking, in that number B, you are to assess whether the company should undertake the project. Of course, since it's a negative NPV, we need to advise. So I would then say the projects, the projects to commercialize. Let me go back to the question in the requirements. You have to assess whether you undertake the project of developing and commercializing the major outboard engine. So I would then say the projects of developing, the projects to develop and commercialize the major outboard engine, the major outboard engine is not financially viable. It's not financially viable considering the negative NPV of 34 million 910,000 naira, 94,910,000 naira. Therefore, the project should not be undertaken. Therefore, the projects should not be undertaken. So that's that. Then number C parts of the question, you have to state your assumption. Like I said, whether examiner asks you or not, is something that you must do. You have to state all relevant assumptions. So in this case, you talk about number C, you talk about assumptions. So the calculation above is based on the following assumption. Number one, you should talk about cash flow. Okay, talk about cash flow. It's the same thing as I've explained earlier under the question of Washington PSC. Then number two, You also talk about cost of capital. You have been given cost of capital of 12%. You need to talk about it. Then number 3, we have inflation in this question. So we talk about inflation. Then number 4, we talk about sunk cost. Not only that, I think we also have other cash flow in the question that we ignore. I think those are the major ones. Then examiner is talking about A and B above. In number A where we calculated project specific, what was our assumption? So you can talk about debt beta because debt beta is assumed to be risk-free. All right. Then number 6, you can talk about debt equity proportion or business risk. You can talk about business risk. Okay, talk about business risk. Once you can list like 5, you are good to go. Now, let me briefly explain. I will not write it down. What do you mean by cash flow? You state that the cash flow estimates are assumed to be realistic and occur at the end of each year. All relevant cash flows have been inflated at the appropriate inflation rates. That's our assumption under cash flow. Then you move on to the cost of capital. What assumption have you made under cost of capital? Examiner has given you cost of capital of 12%. You then say the cost of capital of 12% is assumed to be appropriate and consistent with the risk associated with the project as well as the cash flow. All right, because we have calculated money cash flow. So it is assumed that that 12% is also money cost of capital. And not only that, the cost of capital of 12% is assumed to be consistent with the risk associated with this outboard engine. Then number 3, we talk about inflation. What was our assumption on inflation? It's assumed that the relevant inflation rates are assumed to remain constant within the period under consideration because, of course, that's our assumption on that. Then number 4, we talk about sunk cost. In the question, we are given in the first paragraph, you are given patent rights. They then say the patent right of 15 million naira and then the development cost of 20 million naira as sunk cost and therefore not relevant to the calculation. That's our assumption on that. I repeat, the patent right of 15 million naira and then the development cost of 20 million naira as sunk cost and therefore not relevant to the calculation. That's our assumption of that. Okay, then the fifth one, we talk about debt beta. According to the question, we are not given debt beta. Therefore, debt beta is assumed to be risk-free. Okay, it is assumed that debt beta is risk-free since it is not given. Okay, that's our assumption in the number A requirement that we calculated, the project specific that we calculated. Okay, then the last one, which is business risk. Business risk in the sense that, we are borrowing the beta of Costaris for Ferrari. So Costaris is the proxy company. Therefore, it is assumed that both Costaris PLC and Ferrari PLC have similar business risk. That's our assumption. That's why you are borrowing the beta of Costaris. Okay, so these are the assumptions we have calculated. If you like, you can also talk about debt equity proportion. Okay, it is assumed that the debt equity proportion of Costaris, debt equity proportion of Costaris, in Costaris, debt is, I think, 624. Debt is 624. Then equity is 1456. I think we calculated it somewhere. Let me be sure. For Costaris, yes. Debt is 375. Debt is 375. Equity is 1500. So it is assumed that this debt equity proportion will not change. Okay, the debt equity proportion of the proxy company of 375 to 1500 as well as 624 to 1454 for both the Costaris and Ferrari will not change. Okay, so that is our assumption, and that's end of the question. That's end of the question. Let me know if you have any question on this so that we can, I'll spend additional 20 minutes of your time. I'm sorry about that. I just want to complete the question. Okay, so if there's no, of course, examiner says you state any three relevant assumption. I've given you 6, so you are good. All right. So that's end of the question. Let me know if you have, any question for me so that we can move. We can move to that's end of uh, capital budgeting. In our next class, we are going to be having risk and uncertainty. Practically, we have about 2 months to the end of the diet, and we still have a lot to cover. So this is the end of capital budgeting or capital investments. So in our next class, we are going to be treating risk and uncertainty. It's related to capital budgeting.
So
So yes, talk to me, please.
where are these assumptions coming from?
Pardon?
Maybe it was when my network went off. I don't know where these assumptions are coming from. Are we just taking any point and discuss under each of the
Ah,
heading? Give me the assumptions. I don't
Kemi,
know.
you're on your own. You are not, assumption is in the question. It's not something you are going to fabricate. I've told you already. The first 4 assumption is a given. I explained this when we had the question on Washington Press. I said, when you evaluate a project, certainly you are going to use cash flow. You are going to use cost of capital. If you are given inflation rates, you need to talk about inflation rate. So the first 3 is a given in any question. If you are given inflation, but if there is no inflation, then the first 2 is a given. All right. So you have to talk about cash flow. You talk about cost of capital. In this question, we have inflation. So you also talk about inflation rates. In the question, you are given patent right of 50 million. You are given the development cost of 20 million. There are some costs. They are not relevant. So you talk about it. Also, in the A part, where we calculated project specific, we are not given debt beta. Therefore, it is assumed that debt beta is risk-free since it is not given. We also talk about debt beta. Examiner says you should talk about 3. This is 7. I also added business risk. What do you mean by business risk? It's assumed that Costaris PLC and Ferrari PLC both have similar business risk. That's all.
But I
So
didn't participate fully in that first question. That was when my network went off.
okay. So
So,
assumption is not something we fabricate. It's in the question. Yeah.
The Wakoka we calculated, I thought we use it as the cost of capital. Or what's the essence of the calculation of the Wakoka?
Which Wakuka?
The project specific cost of equity that we calculated.
So what about it?
I thought we use a cost of capital.
No,
But we
now we
use
calculated cost of capital. Hold on. We calculated project specific cost of capital to be 12%. No be so. This is it now. This is,
yes,
but
yes.
examiner says irrespective of your calculation in A, assume 12% as a discount rate for your assessment. So it has nothing to do with the B part. Examiner know the answer you have gotten in A. That's why you are given that 12%. But examiner is also aware of the fact that there will be some students that will not get that number A correctly. They now ask you to use 12% to evaluate your project. All right?
Thank you, sir.
Yeah. Okay. So like I said, in our next class, we are going to be starting risk and uncertainty, and it will take us for about 3 periods. It will take us for about 3 periods. So let's get ready for that. I will encourage you to go ahead, go and study it. All right? Go and study risk and uncertainty so that in our next class, that's what we are going to be doing. So that if you already have the idea, it won't take time for you to understand when we are discussing the concept. All right. So thank you, everyone. I will see you next time by the grace of God. Good night.